5 seconds to the open.
Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
All right, friends, welcome to you all around the world. Welcome to the Follow the Money podcast. Today's episode number 506, we've entitled Stay the Course, because right now that's exactly what most investors are struggling to do, because we got rising geopolitical tension in the Middle East. We got this war raging between the United States and Israel against Iran. We've got volatility obviously rocking the energy markets. We've seen the biggest surge in oil prices in a single month in history. We've got sharp pullbacks in some of the biggest names in tech as well. We're going to get into that in segment 2. We've got some pretty interesting opportunities on the horizon, in my opinion. But anyway, when all that hits at once, it really can create something dangerous, let's just put it that way, for you. Not just the uncertainty of it all, but a temptation for you to make emotional decisions about your long-term strategy based upon short-term, events. So today what we're going to do is we're going to slow it down a bit. And in segment 1, we're going to walk through the recent volatility tied to the war against Iran and energy prices and why all of these latest events can really test long-term investors the most. And then in segment 2, I'm going to walk you through the markets. We're going to talk about why big tech stocks may be presenting a really good opportunity right now. I'll also give you a full breakdown across the S&P 500, the Nasdaq 100. We'll look at gold and silver. We'll look at oil, the dollar, and Bitcoin as well. And then we'll close out with a simple, but I think a very powerful reminder about investor discipline right now, right? Because over time, if you're wanting to build wealth over the long run, you've got to stay focused, right? Volatility is totally normal, but how you respond to it, that's what matters. So let's dive right in. All right, so it's been a really wild Q1, right? Q1 is in the bag. It's all over, quarter one. We move now into Q2 2026. And the last 3 months have been pretty wild. 2026 is a crazy year so far. So let's talk about what's driving some of these headlines that have been spooking so many people. First of all, over the past, several weeks, and especially the last few days, markets have really been getting rattled by the escalating tensions in the Middle East. We are talking specifically about what's been going on in Iran. And you've seen the headlines. You've seen the spike in oil prices. You've seen that we have seen the Strait of Hormuz closed for the first time, and the nations are reeling from that. They're trying to deal with that situation because 20% of all the world's energy supply, plus many other things, fertilizers and phosphate and helium. Helium has been another big deal. The ammonia and sulfur, all of these things that are so impacted for the food supply, right? So we are concerned about some of the things that could happen as a result of this Strait of Hormuz being closed. Of course, we're already seeing it at the gas pump. We're seeing it, in many places. So there's a lot of potential fallout that we still have to see. We haven't even gotten the inflation numbers yet from what this impact has had upon, that. So we're going to get March inflation numbers, and then of course April inflation numbers may be, sustained higher as well. So we've been seeing it, right? We've seen the spike in oil prices. We've seen volatility pick up across stocks. We've seen tech stocks really get hammered. We've seen cryptocurrencies still languishing way down near their lows. We have commodity prices, which have been kind of erratic. And when that happens, obviously it's pretty predictable that people begin to fear, right? They begin to fear in the markets. Investors begin to ask many of the same questions. Is this the start of something bigger, right? Should I get out of my position? Should I wait all of this out? Is it different this time, right? All these questions arise in the investor mind. And we get questions here all the time from our members and people who are just, curious of what we would say. So I want to make it clear in this broadcast how we're viewing all of this right now. It's important to understand that, geopolitical events like what we're seeing now obviously can impact energy markets. They totally impact sentiment, investor sentiment. They can even trigger short-term corrections like we've seen with the Nasdaq 100 falling into a correction amid all of this. But what I can tell you from over 2 decades now of investing in the markets and trading is I've rarely seen these kinds of events change a long-term trend just on their own. And that's where a lot of investors, I think, get tripped up. They take a short-term shock. And admittedly, this is a big shock. Don't let me minimize it. I'm not trying to minimize it. But what they do is they take a short-term shock and then they turn it into a long-term decision, right? They take the headline and they allow it to override their entire long-term strategy, their entire financial plan. And in so doing, they often do the exact opposite of what leads to long-term success, right? They sell into weakness. They chase the strength, but then when the weakness comes, they sell into the weakness, and they repeat that cycle over and over again. And that's why so many people underperform the overall markets. For many people, it's just better to buy an S&P 500 ETF and sit in it and forget it. I mean, this is the advice that Warren Buffett even gave. If you're not going to be able to sit through the drawdowns and actually take advantage of those drawdowns and add to your positions in high quality assets, then, it can become not only stressful for you, but it can be unproductive and unprofitable for you, right? To be an investor because you're constantly selling into weakness, right? We've seen this same pattern play out during wars. We saw it play out during the pandemic. We've seen it play out during financial crises and political shocks. And yet over and over again, if you go back and look at the chart, the markets just keep continuing to climb. They dip and then they go back up, not in a straight line, of course, not without any kind of pain, but there's a clear long-term upward bias that's driven by several things. Number one, innovation. Number two, productivity, which is continuing to increase, and growth. But remember, we also live in an inflationary kind of society. Our entire monetary system is just rooted in inflation. And so they're constantly printing money, and that dilutes the value of the dollar. And so if you're not invested anywhere, you're just sitting there holding these eroding dollars. So you have to put your money somewhere. And when you do put that money somewhere, if you're jumping in and out, in and out, in and out, every time you get scared, you're not going to be able to get that long-term compounding growth that you need to overcome the inflationary pressures of a society like ours. So the real issue is not volatility, right? Even though that seems like it's the real issue, it's not. The real issue is whether you have a framework that allows you to navigate market volatility without losing your footing. Because if you don't have a plan, then every single headline that you see that scares you can feel dangerous to you, and it feels like it's a signal to sell, right? Every dip can feel like it's very dangerous, and every rally you're going to feel like you're late, right? And so you're going to have to play catch up. So you're going to sell into weakness, and then it's going to pop, and then you're going to chase the rally. And again, if you do that over and over again, it's going to become very unprofitable. Believe me, that's how I got started. As an investor, I was a sloppy investor, very, very challenged when it came to controlling my emotions. And over time, I've just had to learn that, right? You just have to learn how to grin and bear it, even whenever you're feeling fear or when the market is signaling fear. You just simply have to be able to realize that volatility can be your friend. When you do have a plan, things can change for you, right? Volatility stops feeling like chaos and it starts looking like an opportunity. That's where our 5 levels of financial freedom come in, by the way. I'm not going to go in deep into all of our 5 levels here. I've already done many podcast episodes on the 5 levels of financial freedom. I encourage you to go check it out on our website, followthemoney.com/5 levels. And there I share with you the step-by-step process that I took to become financially free, right? And that framework is really designed to give you stability in moments exactly like this. Many of our members have been using that 5 levels. They've been climbing through those levels as they achieve financial freedom. And obviously for some people who aren't even invested in the market, they're just kind of getting started. at the base level with our 5 levels of financial freedom, you're just really kind of focused upon survival, right? You're trying to create cash flow. You're trying to eliminate high risk debt. You're trying to build a financial floor. But from there, you can really begin to build and move into a more stable environment. You can, move towards financial independence, and at each level, you're going to notice that your relationship with volatility changes. When you're at a lower level, volatility can feel threatening. When you're kind of climbing, in your knowledge in terms of investing, when you're just getting started, the volatility can feel very threatening to you. But as you stick around and you go through a few cycles, you begin to notice that volatility can actually become an opportunity, right? And that's a really big thing that you can really kind of graduate into. I've seen many of our members who have learned to embrace volatility, and it's turned out to work out very well for them, right? But again, this is where a lot of people go wrong when it comes to our 5 levels, or just when it comes to building wealth, is they often try to invest really aggressively without laying any kind of foundation. And then they try to time the markets without any kind of framework. And then when volatility hits, they don't have anything to anchor them. So they just react. They emotionally react. They instead of responding in some sort of wise fashion and thinking it through, they often just emotionally react. And that is a major difference, because the investors who win over time are not the ones who avoid volatility. They're the ones who are prepared for it. They're the ones who understand that volatility is not a flaw in the system, as we often say, but it's the price of admission. Now, does that mean that you ignore everything happening in the world with your investment portfolio? Of course not, right? You can stay informed. You can understand the risk. You should. You should recognize that energy prices matter. You can realize that geopolitical tensions are going to escalate, and they're going to wreak havoc sometimes upon your strategy, right? But you don't have to abandon your plan every time that uncertainty raises its head. Because if you do, then you end up spending your entire investing life moving from one emotional reaction to the next. And that's not a strategy, right? That literally is just living in survival mode. So as we move through this episode, I want to keep one idea in mind for you. Just as we have titled this episode, Stay the Course, I want you to realize that staying the course is a decision that you have to make, right? It's a discipline that you have to engage in. And in most cases, it's really the best response to any situation that's going on, being able to stay the course. In other words, in order to stay the course, you really have to be bought into your overall strategy. And I think that's probably why many people, they become emotional and emotionally react to short-term events, because they may not be very well anchored to their overall strategy. So it feels kind of flippant. And so I just bought this stock last week, I guess I'll sell it now because I don't want it to go down. Whereas there's really no long-term plan, you see what I mean, when it comes to investing. And so I think this is a really important topic, and I'm really glad we can be doing an episode on this topic today. Now, we're going to move into our next segment. What we're going to do is we're going to shift from the fear and the volatility and all the things that have been going on to the opportunity. Because while the headlines are completely focused upon the conflict, markets have been quietly repricing some of the most important assets in the world. Let's take a quick break and we'll come back and talk about it. Stay with us. Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-12
2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back to the program. My name is Jerry Robinson, founder of followthemoney.com. You can find us online right there, followthemoney.com. We have lots of resources for you there, free and also premium resources for our members. We have gobs and gobs of information for our premium members, including lots of trading ideas every single day, new investing ideas, lots of education, tons of courses, all that stuff. You're wanting to learn how to invest, how to break free financially, followthemoney.com. Love to see you here. Now, all right, let's shift gears. Let's take a look at the markets because obviously the headlines are very loud right now. The charts are usually a little more honest, right? When you look at the data, you tend to see a bit more of reality. So let's see what the data are telling us. And what we're seeing is not really panic. We're seeing some pressure. We're clearly seeing some volatility, but we're not really seeing a complete breakdown, right? In fact, the S&P 500 has pulled back. Yes, in fact, when we take a look at how it's currently performing as of for Q1 with the first 3 months now behind us, when we take a look at how the S&P 500 returned during that period, it was negative 4.4%. And so you look at that and say, well, that doesn't sound that extreme. That's down slightly, but it's not down too dramatically. Now, we did call a new position downtrend for our members back on March the 20th. So we did see that, but we're still in a long-term uptrend. And so we're really just kind of moving through the motions here where the market is starting to rebound on rumors that we may see an end to the conflict in Iran sooner rather than later. We can all pray and hope that that's true. But regardless, when we look at what's happening with the S&P 500, that large, massive index that is really a comprehensive index for tracking the broader U.S. market, we see that the trend is still intact. That uptrend on the long-term view is still intact. So everything's still pretty much normal here. Now, let's talk about where the real story is, in my opinion. I think what we're seeing right now is a good opportunity in terms of tech stocks. Now, technology is a space that I've been focused on for many years. It's become one of my niches, specifically the Nasdaq 100. The Nasdaq 100 down nearly 6% for the first 3 months of the year. And that, of course, is that non-financial index where you have a lot of, big tech companies, a lot of the, biggest names in the country in that Nasdaq 100 index. Now, over the past several weeks, we've really seen a meaningful reset in valuations across the tech space. And that's not because these companies suddenly became, poor businesses, but instead because expectations just got stretched and then they got corrected. That's how markets work, right? Prices tend to move ahead of reality sometimes, and then reality catches up. And when that happens, you get what you're seeing now. You get high quality companies that are trading at better prices. So we really haven't seen the leadership change. The Nasdaq 100 is still driven by the same forces, the artificial intelligence trend, the cloud computing trend, semiconductor demand, which is going to continue. We have this global digital infrastructure that's being built out. And at the very center of that is Nvidia, But let's talk, before we get into Nvidia, let's just talk about big tech stocks. Tech stocks have definitely taken a hit in recent weeks. But according to a new Bloomberg report, U.S. technology stocks are now trading at their cheapest valuations relative to the S&P 500 index in more than 7 years. So you got to go back to 2019 to see U.S. tech stocks trading at their current valuation, right? And you compare that to the tech sector's peak overvaluation, which was back in June of 2024, when it was nearly 50% more expensive than the S&P 500. So basically what's happened over the last few months, especially the last few weeks, is that valuation premium that big tech has long enjoyed over the broader market has nearly disappeared this month. So today, the Nasdaq 100, as we sit, is trading only slightly above the S&P 500 index on a forward PE basis. That's a really rare setup that has usually preceded periods of strong outperformance. Now, part of that reset, of course, is what we talked about in segment one. You got war in the Middle East. You got inflation concerns, right, due to this war and surging energy prices. You still have lingering questions, too, about AI spending. That's shaken tech investor confidence. And as I was mentioning, Nvidia, that's actually my largest holding personally. That's my largest personal single stock holding in my long-term investment portfolio. And its forward PE ratio has fallen to pre-ChatGPT levels. That is, when ChatGPT came out, that was a huge boon to the tech space. It was a huge boon, of course, specifically for Nvidia, because they were creating the chips that were driving this innovation in generative AI. And despite its healthy margins, I mean, Nvidia has some of the best margins in the world for any kind of corporation, and its explosive earnings growth as well. If you look at its forward PE ratio, it's trading at its lowest level since 2019 and recently fell below the S&P 500's forward PE ratio. That almost never happens, right? By the way, if you're listening and saying, what in the world is a forward PE? What does he mean by that? Well, that's a ratio they use in fundamental analysis. And in simple terms, it just simply tells you what investors are willing to pay today for a dollar of tomorrow's earnings. That's why I think it's one of the clearest snapshots of market expectations and valuation. So right now, as I look across the tech space, I see a lot of opportunity. I see a lot of strong earnings growth trading at a discount. And as we speak, I'm looking at a chart now of the Invesco Nasdaq 100 ETF, ticker symbol QQQ, and we are beginning. We had a 200-day moving average breakdown on the chart a couple of weeks ago. We are now moving back towards that 200-day moving average on pretty decent volume. So it looks like we're trying to reclaim that key area. Also, if you look at a weekly chart of the Nasdaq 100, I like to look at the 50 weekly moving average. That area also being recaptured after we close the week below it. We're now back above that level. Let's see if we can close the week above the 50 weekly moving average on the Nasdaq 100 ETF QQQ. We've certainly seen a rebound as of late. And by the way, let me also mention something about the S&P 500. I forgot to mention a key level I'm watching on that. We did dip below the 200-day moving average also on the S&P 500. We moved down into a demand zone that I define from 6150 all the way up to about 6500. That area is where we see a lot of demand for S&P. And so far, we dipped into that area, and now we're back out of it. We're back above 6500 as I record this episode. So we spent a few days there, and now we're back up. And we may be on the verge of reclaiming that 200-day moving average. That's currently around the 6640 area. So if we break out above that, then you're going to be within striking distance of a new record high. So again, we're not too terribly far off from the previous all-time high here. We've had a dip. We've lost the 200-day moving average, but now we're moving back higher. This could end up being, friends, another very good opportunity in these markets. We get these dips occasionally, and when they come, it all depends on how you view them. If you're scared and fearful, you miss out oftentimes. And if you're opportunistic and looking for an opportunity, then you can do well. And I'll tell you, the way that I have approached it personally is I use a DCA strategy, a dollar cost average strategy, which we'll talk more about on another episode. But just dollar cost averaging is where you take kind of the same amount of money and you just put it in on a regular basis. I do it every week. I do a DCA Friday strategy. So every Friday afternoon, I like to buy my favorite stocks and ETFs and cryptos for my portfolio. And so it's just kind of, it doesn't really matter what the price is. Of course, if the price falls dramatically, then I'll usually add a bit more than I would normally. I take advantage of, dips. But right now, this is what I do. So I'm not just backing up the truck. I'm not looking at the prices and saying, oh, I'm going to put all my money in right now. No, we just continue to DCA through the good times, through the bad times. And in the end, it all kind of works out in the wash, as they say. Now, let's broaden out a bit and talk about the U.S. dollar, because the U.S. dollar has remained relatively firm throughout all of this. It tells you there's still global demand for safety and liquidity. When things get uncertain, you tend to see capital move towards the U.S. dollar. That hasn't changed in this current scenario. However, I would say that the dollar has been weaker than many people perhaps might have thought. it has not performed at the level at which perhaps it has in the past on these kinds of events. So I think that's somewhat telling and somewhat interesting. The key level I continue to watch on the US dollar index is the 100 to 101 range. That's a really important level where we've just continued to get bat down. It's served as support through 2023 and 2024, but then it became resistance in 2025 and then into 2026. So 101, if you see the US dollar index break out above 101, then that would be, I think, significant. But right now we're not there. In fact, we're backing off right now. We're currently at around 99.50 or so as I record this episode, maybe even a little lower than that. Let's talk about gold and silver, because gold and silver have also been somewhat interesting in this environment. For the most part, we saw weakness going on in gold and silver during the outbreak of the war, and throughout the month of March, for the most part, we saw weakness. Now, why is that? Many people thought, well, why in the world would you have this war going on, and then you have these safe haven assets like gold and silver going down, right? That was kind of strange to people. Well, there's a few reasons. Number one being that in times like this where you start to have declines in the markets, people will often sell first and ask questions later, right? You have to remember also there's been a lot of Johnny-come-latelys on the gold and silver train because it brought in a lot of momentum traders, right? Because if you've been trading gold and silver or investing in gold and silver for a long time, well, that it's become a crowded trade over the last few months, right? Where everybody's seeing this, rapid rise. And so there's been a lot of people who came in who didn't really have a long-term strategy. They were just there for the momentum. And so when it began to come down, they got out. You also had people having to sell to take care of margin calls or whatever with the market coming down. So many people turned to their gold and silver. And so we had some big high-profile investors overseas as well who were liquidating a bit of their gold and silver in order to take care of, margin calls or whatever. So we saw a little bit of that, but we're starting to see a rebound now. Gold actually came down and almost touched its 200-day moving average for the first time in a long time last month, March, because we are recording this on April 1st now. So March is last month. But as we look at the price action today, as we open up the month of April, we see that it's breaking out. It's moving closely right now to the 4,800 level, which is really pretty darn bullish when you think about gold. So it's breaking out of the demand zone that we had defined somewhere between 4,400 and 4,600, and now we're breaking out from that level. Let's also talk about silver, because silver had pulled back as well. In fact, it set a new low back in the middle of March, a low that we hadn't seen since last year, but it's rebounding as well today. It's up above the $75 level as I speak, so we are seeing a nice gain here in silver as it tries to turn around. Now on silver, the really key area that I watch is the 30 SMA on the daily chart, especially for those who are more near-term minded. And then when it comes to the price of gold, I look at the 100 SMA. Very, very important metric for each of these. The 100 SMA on gold, the 30 SMA on silver on the daily chart. And I'm watching those right now. These are key areas to watch, in my opinion. But of course, oil has been where it's at, right? I mean, this is where we've seen the biggest gains this year. In fact, when we look at the first 3 months of the year, tracking all the different major markets, we tracked 10 major markets in our weekend report we put out for our members called the Robinson Report. And the top performing asset out of those top 10 markets was obviously U.S. crude oil. The ETF we use to track it, DBO, up 61% in the first 3 months, right? That's incredible when you think about it. Gold was up 7.3%. That's not bad. Silver was up around 6% on the year so far, year to date. And the dollar was up around 3%, right? So you can see that oil has really just been crushing everything. And that's usually not a good thing. I often joke about how energy usually is the one, when it finally rallies, when you get the energy sector to really rally big, it oftentimes kind of ruins the party for everybody else. It usually is a kind of a late bloomer. It tends to rally late in the cycle. And when it does, it can really bring everything else kind of tumbling down. So we'll be watching very closely these markets to see how sensitive they're going to remain here in Q2. But, the oil markets clearly have just been on the ascent. They began rising at the very beginning of the year. They enjoyed a good January. They had a good February. but then March was off the charts. Now, we've pulled back a bit on oil because we continue to get these mixed signals that there's going to be some sort of peace deal between the U.S., Israel, and Iran. We don't have anything in writing. We don't have any detail. From what I understand, the president is going to be addressing the United States from the Oval Office, I believe, maybe from Mar-a-Lago, but he'll be giving a address to the nation this evening, and so we may get some more clarity there. Hopefully, he's going to tell us that we have a peace deal, but if that's not the case, then we need to be prepared, right? And that's what this episode is really trying to prepare you for, is just, to be prepared for any kind of outcome, right? To always be at the ready and have a plan. But oil pulling back right now, and that's really good news overall. If we can continue to see these oil prices come down, it's going to take a lot of pressure off of earnings. It's going to take a lot of pressure off of inflationary pressures in other items, because energy, of course, is an input on almost every good. And so, oil, wow, we've just had an incredible rally there. Will it continue in Q2? That's a big question. We'll just have to kind of watch and see. Now, let's switch gears and talk about Bitcoin and Ethereum very briefly here toward the end. These have pulled back along with risk assets as well, but we also have seen them show a bit more resilience since the war broke out. In fact, we're still trading well above the February low that was hit near 60,000 on Bitcoin. Right now, as we speak, we're sitting pretty close to about 69,000. We're sitting right at a 50-day moving average on the daily chart on Bitcoin. We're well below a declining 200-day moving average. And if we turn a look at Ethereum is still holding above that key 1750 support. We're also trying to hold above the $2,000 support level. And so far, that's what we're seeing. So both Bitcoin and Ethereum still behaving like a risk-on asset in moments like this. Even when the uncertainty is rising and the liquidity is tightening and the volatility is increasing, crypto tends to feel it. But again, pullbacks and long-term uptrends are not unusual across the board. Unfortunately for Bitcoin and Ethereum, they're both locked in really nasty long-term downtrends. And so we don't expect that to really resolve until closer to the end of the year, when we expect to see Bitcoin and Ethereum begin to resume their move higher. So let me just sum it all up here. What's the takeaway? Well, it's simple. We are seeing stress in the markets right now, but we're not seeing a collapse. We're seeing a repricing of assets, but we're not seeing a destruction of asset prices, right? And so in markets, those are two different things. And that's where discipline really comes into play, because the same volatility that shakes people out is the same volatility that creates opportunity for others. And right now, in areas like big tech, especially just the entire tech sector right now, we're starting to see that opportunity really emerge. Not because the world is completely calm, but because the opposite, because it's not. And that's why the opportunity is potentially staring us right in the face here. That brings us right back, of course, to the core idea of this episode. You don't build wealth by reacting to every headline that comes out. You build wealth by developing a long-term strategy and following that plan. All right, let's take a quick break and we'll come back with a final thought. Hold tight. All right, friends, welcome back to the final moments of today's broadcast. I want to bring this all together now because we've talked about, in this episode, war headlines. We've talked about the market volatility. We've talked about big tech stocks pulling back and creating opportunity. But underneath all of that, this episode really comes down to one simple idea, and it's this: do you have a plan? Because when the markets get shaky and headlines get loud, as we've talked about, the fear starts creeping in. That's when your plan either holds or it doesn't. And here's what I've seen over the years. Most people, you've heard it before, most people don't fail in the markets because they pick the wrong stock. They fail because they abandon their strategy at the worst possible moment because they get emotional, they react. They move away from their discipline and they move towards impulse. And that can be very expensive. And it's a truth that I've tried to get across many times through this podcast. That is that volatility is not a bug in the system. It's a feature. It's the price you pay for long-term growth. And if you don't understand that, you're going to constantly be stepping off the train right before it leaves the station again. That's why I always emphasize the need to have a holistic financial plan. Not just investments, not just trades, but a complete, full-scale framework, right? We've talked about the 3-bucket strategy here many times before. It's a very simple strategy: the liquid bucket, the safe growth bucket, the risk growth bucket. Basically understanding where your money is and why it's there. And that's what gives you the ability to stay calm when others aren't. It's what gives you the ability to act when others are freezing up in fear. And in many cases, that's what allows you to simply do nothing when nothing is required. And sometimes that's the most profitable move of all. Now, before I close, I want to leave you with a final word. And this one that I've used before, but it's so appropriate today. It comes from the recently retired Warren Buffett, who said the stock market is a device for transferring money from the impatient to the patient. Simple quote, but incredibly powerful. Because what he's really saying is that the market doesn't reward activity, it rewards discipline, right? It doesn't reward your emotion, but it will reward your patience. And in times like these, when the headlines are screaming and the volatility is high, this truth matters perhaps more than ever. So if you remember nothing else from today's episode, remember this: you do not need to predict every move to succeed with your investments. You do not need to react to every headline, but you do need a plan. And you need the discipline to follow it. And that is just something to think about. If you need help getting your plan started, feel free to reach out to us. We can put you in touch with one of our advisors around the country. You can contact us right here through our website, followthemoney.com/advice. Or just email us. Go to followthemoney.com/contact and shoot us an email and say, I'd love to get connected with a financial advisor who can review my current financial situation and see if you can help me at all. Be happy to do it. Reach out to us. We're here to help. And finally, remember, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.